Hello and welcome to Portfolio Matters. Thank you for all your feedback on our opening episode. And as a result of that feedback, we have worked out that our 2-minute pitch really didn't work very well. It was great fun, but I think actually you want a bit more than fun. You want some serious stock analysis. So we are going to change policy and we're going to do a series of share talks where we both discuss the company and come up with a conclusion. So we're going to redo my earlier pitch of Tekmar now in greater depth because Richard asked me about the declining margins and I have done some more digging on that. So before we get going, I'll pass over to Richard to do the disclaimer. Take it away.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Thank you.
Thank you, Richard. Right, let's go. Right, I'm afraid there may be some repetition for those of you who have watched the introductory episode, but we're going to go from the beginning. So, Tekmar is a clean energy company, which is one of the reasons I'm interested in it. I think that there's going to be a secular shift by governments to try and prioritize clean energy. And Tekmar is an engineering subsea cabling supply company.
Okay.
And if I can, right. So it used to provide pipelines for the oil industry, but has repositioned itself to do subsea engineering and cabling for the offshore wind sector, which is obviously growing very quickly and is being prioritized by governments who are fairly price insensitive, always something we like. Okay, so this is from Tekmar's 2020 annual report and shows some of the stuff they do.
Right.
Which is, frankly, I found amazing. I mean, I had not realized quite how much extra stuff there is on the seabed underneath a wind farm. And of course, this is for mainly embedded shallow water wind farms, and coming on stream are deep water floating wind farms, which will require even more things. So I actually looked up what a frond mattress was because I didn't know. And okay, so well, it's one of the interesting things about researching all these companies. You find lots of interesting stuff. So scouring, as the currents move around the base of a wind turbine, they move the sand away and the sediment away, which obviously exposes the foundations, weakening the structure. So therefore you need these things called anti-scour frond mattresses, which stop that happening. And that's one of Tekmar's businesses. In fact, it's a business it seems to have bought during the year.
Mm-hmm.
So you see that now 66% of the revenues are coming from offshore wind, with the only about a third coming from the original oil and gas sector, all of which is great. So moving on, these are from the 2020 annual accounts. In fact, no, these numbers are from Stockopedia. So they're the cleaned up numbers that Stockopedia use. And So you'll see the revenue was growing very strongly into 2020, and the annual report is full of forecasts for very strong revenue growth around the world. They have been.
Can
Sorry,
I
Richard?
ask a question there, Keith? You got 42.2 in 2022 as the estimated. Is that
Yes.
correct on the basis of strong growth?
I don't know. I mean, frankly, this is from Stockopedia. One thing you do know is that the subsequent to these annual reports, they issued a revised forecast and a profits warning in October this year, where they forecast actually sales would fall by 10% in 2021 compared to earlier forecasts, because projects had not been cancelled, but they had been deferred because of COVID. And one of the reasons I like this company, and it looks so cheap, is that the market reacted to that incredibly badly. So that 10% cut in revenue growth led to a 40% drop in the share price. Now, it has since retraced a lot of that. But what I notice is that prior to the profits warning, the shares seem to be very illiquid. And you see on the chat sites that people were complaining about the difficulty of getting hold of shares. And it seems that one of the reasons the shares fell 40% is in some institutions dumped shares. And now it's much easier to get hold of the shares, which is good.
Yep. Okay.
Now, and the other thing I really wanted to bring out was the fact it's got cash. It's got net cash. Yeah. So when you look at the 33 million market cap, net it's only worth, market cap's only 31. But the question Richard raised when I pitched this to him on Friday was the declining margins. And we have some answers, but not a definitive answer as to why that's happening. And note that that was happening prior to the recent profits warning and is a cause for concern. Now, on a gross basis, the margins have held up. And so in the 2020 annual report, you'll see the gross margins across all sectors are about 30% and seem fine. So
what's their year end, Keith?
Right, that is a problem because they're changing it.
Right.
It used to be the 31st of March. And now going forward, it's going to be the 30th of September. So the 2021 annual report will cover an 18-month period. Okay, so from the annual report, this is the 2020 annual report. You see, everything was looking very good. 48% year-on-year revenue growth, big sales pipeline and inquiry book, and increasing offshore wind, basically, subsea and offshore wind. So gross profit looking good. Gross profit margin 30%. Okay, so down from 41%, but still very good. The way Tekmar operates is that it acquires legacy businesses, so lifestyle businesses, and it's creating this conglomerate of subsea engineering companies. And if you listen to the CEO interviews, he talks about how these tend to be lifestyle businesses, quite small companies where there is a founder who wants to leave. And so then it's a question of basically keeping the people, the important people in the business for a few years and assimilating it into the company. So the latest acquisition was Pipe Shield International, which does the Frond mattresses, etc. And one of the things I noticed was that if you look at the revenue bridge, Pipe Shield International added 3.1 million during the year. and actually I'm forgotten now when they actually bought Pipe Shield. That may be part of the reasons it was only 3.1. But Pipe Shield brought in 23 people. So it brought in a substantial number of people to the company. So I wonder whether the margins are being affected by a lower margin business, and that would make sense. I mean,
still tell me, if you don't know the date of acquisition, you don't know what the contribution, what fraction of a year the contribution of 3.1 million represents. I take your point.
Yeah.
Hard to extrapolate.
Also, it would, it would seem that these are not highly engineered products. It would make sense that they're lower margin. But Tekmar do not split out the margins by each subdivision, so it's difficult to tell. Going forward, I mean, the inquiry book is very strong, and it has. If you look at the update, the most recent update, the inquiry book continues to be decent. It's just that projects have been delayed rather than cancelled because of COVID. And one of the reasons that they gave for the profits warning is that they have suffered disruption to the supply chain from China. Now, that won't have affected the year end, the 31st of March, very much, because this disruption happened on the 6th of February. So it was when they talked about a cessation of supplies from China. And then they had to get alternative supplies from Italy, which were expensive. So that actually will have impacted some of the 2020 annual report, but obviously it's only what 10% of the year. So that will not be responsible for the large decline in margins.
Okay.
But what I want to take away from this is that there is a good order book. And during the year, they sold to China for the first time, Japan and Saudi Arabia.
Have they issued interim accounts, Keith, for 6 months?
I think they did, actually. That's what I read that, but I've now forgotten. So I read the latest piece from them. Anyway, here we go. Yes, they did.
Right.
H1 2020 financials, six months to the 30th of September. So this is in advance. So you'll see that revenue dropped, and this is what the market took so badly. So there's gross profit was down. Actually, on an EPS level, they're now loss making. So all of that was rather a shock to the market. And I mean, the reason I was interested in this company was that the shares seemed cheap and that it was in a growing sector. And all that is true. However, right now, they're undergoing a little local difficulty, some of which is certainly due to COVID and supply disruptions from China. And one of the things that investors were complaining about was that the company had not made clear that its supply chain was from China. And so people were surprised when suddenly, they couldn't actually complete projects because of COVID disruption. And so then they had to do this emergency supply from Italy at much higher cost.
Okay.
Okay, so where we are. The shares are, well, today they're about 66p. There's quite a large spread, 64 to 67p currently. The market cap is 33.5 million. And during the year, they've added the this pipeline international, so subsea pipeline business, PIL, which is innovating and creating version 10 of its system, which maintains margins but is cheaper. So you would hope.
Keith, can I just comment on this? So it looks like the market cap in early 2020 was around about 100 million.
Yeah.
And profits were expected profits after tax were about 4 to 5 million. So they were rated on a price earnings ratio of, so let's say 20.
Yeah.
So if they if that's a reasonable rating for a company like this, you can sort of, if you can work out what their future earnings ought to be and put it on a ratio of 20, you may come up with a sort of derived expected share price once they move back into normal operation.
Absolutely. But the thing is, Richard, currently, if it moves into growth, it should be re-rated as a growth company.
So if you look at the order book or the inquiries, I think it was 220 odd million, wasn't it, with a 56%, let's say a 50% conversion. Well, if they can maintain that for a couple of years, that gives them a turnover 100 million.
Yeah.
If they put their margins back up to where they were, it gives them a profit of 10 million.
Yeah.
Which puts them on a market cap of 200 million and a multiple of 20, which is 6 times what it is now.
I like your numbers, Richard.
So you like the numbers. That's the sort of, I mean, there's a lot of ifs and buts in there, but if everything works out, as you would hope it would if you bought these shares,
yes,
you're looking for that, possibly for something of that order in terms of price increase.
Yes.
But there's a lot of execution that needs to happen to achieve that.
Absolutely. I mean, frankly, I the way I look at companies is that I don't like do any modeling, but what I'm looking at is this the growth industry? Do they have a defensible position? And, right now, when everything is disrupted from COVID, I fully expect the sales to be down.
Yeah.
So when the market recovers, where will they be? And if nothing else has changed, you would hope that their share price would get back to somewhere close to where it was pre-COVID. And as they have added this pipeline business, I would say going forward, they should be in a better position. I mean, obviously, the 2020 share price will include the fact of the new acquisitions, but it's putting together this conglomerate of businesses in subsea, where offshore wind is clearly a priority, and you'd hope once it returns to growth that the share price should get back to at least where it was. So, if you think about the margin of safety, where's the margin of safety here? Right now, sales are depressed. Can they get worse? Well, I think COVID's improving. And so therefore, when we come out of COVID and all these projects get back online, then I think downside is limited, decent upside potential would be my naive summary.
Yeah, I understand your reasoning, Keith. I think it's all down. I suspect you're right. The market will come back. We are getting towards the end of the damage that COVID is doing. The offshore wind sector is going to develop further. There's also going to be ongoing maintenance to be done, which presumably will start to develop some significant maintenance contracts. Do they operate internationally? Do you know?
Oh yes, no, they're worldwide. I said that they sold into China,
So
sold into
their potential
Japan.
market, sorry.
Yeah.
Their potential market is large.
Absolutely. And actually, one thing I haven't mentioned, which is important, is the average size of their contract is 2 million quid, okay, which represents around 0.1% of the cost of a wind farm. Okay, right. So it's a pretty small part of the project, and they claim that that makes it a bit of a no-brainer. And there's limited competition because actually it's not a very big market. Okay. And hence they should be able to maintain margins.
Very interesting, Keith. I think that's an interesting company and a good spot. How did you come across it?
I came across it digging around in clean energy companies, and then I looked it up on Stockopedia, and Stockopedia ranks it 75 for value, which is good out of possible 100, and 75 for quality, also good, and 8 for momentum, i.e.
it's not moving.
It's going down. All things I like.
It's certainly, if they could execute it, the price will re-rate.
Yeah, absolutely. So, in summary, exposed to the growing offshore wind sector with a strong competitive position in some niche markets with new products coming online, but it has warned that it is seeing some competition. Share price is depressed. We like that. It's a global business, which hopefully will benefit from the fact the pound is so weak, and it's got net cash. However, it has had a profits warning. It's clearly lost the confidence of some of the institutions that backed it in its listing, which was only a couple of years ago. The margins were declining pre-COVID. Now, at the top line, the margins seem to be holding up. And frankly, we haven't really got to the bottom of that. So you would have to assume that the margins will recover. And the other thing, actually, we haven't mentioned, we need to mention, is that it does have a cash flow issue in that the trade debtor numbers are very high. So what seems to be happening is that it does the work on these projects, but it only invoices at the end of the project when they have completed their part of the project. So
it only gets paid at the end of the project.
Precisely. Yeah. Exactly. So in the meantime, it has to fund its work.
Yeah.
So whenever it gets a new project, it does all the work, but then at the end, it invoices and gets paid. So one of the side effects of that will be that if it does get a load of work, it will have to fund it. So you'll see that during the year, it actually got a bank loan of £3 million to fund inventory, etc.
Yeah.
So, and as I mentioned earlier, there's rising competition. And I should, of course, mention I have bought a decent chunk of this because I like it. And it's a value stock. This is not a little speculation like some of the spivvy copper mines that we were talking about last week. This is something I think I can see holding for the entire cycle.
It also has a strategy, Keith, doesn't it? The chief executive has a strategy of accumulating small specialist businesses and putting them into a full service group.
Yeah. Which
gives an economy of scale and also a greater an efficiency to the contracting organisation as well, because they contract with just Tekmar as opposed to 5 or 6 small subcontractors.
I should also mention that there's new management. So one of the things that happened in 2020 was that they're basically restructuring the business. So the interviews you have online are all with the new CEO. So hopefully, the new brooms come in clean sweep, restructured the business. He's cut the manufacturing capacity by 25% because he thinks it can be used more efficiently.
Right.
And there was a reduction in, there was some redundancies as part of this restructuring. So, you hope that what's happening is that the plans have been, he's taken the costs of the restructuring and reorientating for growth, and then COVID happens and upsets all the plans. But once the COVID disruption is out of the way, then the company can find its feet. Growth returns. I make a load of money, and in 5 years' time, we do one of these where I've sold it at vast.
Excellent.
We do this from the Caribbean.
Well, thank you very much, Keith. What I think we probably need to rechristen the 20-minute pitch. That was very interesting, and I thought you presented it well with some very useful information.
Thank you, Richard.
That's a pleasure. So the only thing that remains now is the full disclaimer.
We hope you'll join us for more of these. Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.